Assalamualaikum warahmatullahi wabarakatuh. Hi everyone, we are from group 7 and we are here recording this video to explain about our material, which is internal control and COSO frameworks. But first of all, we need to introduce our group members. First, we have Shaquila Dania Putri, and next is me, Cindi Nabila Andri, and Muthia Putri Hefra. So we're just getting into the first learning objective, which is will be presented by Shaquila Dania Putri.
Okay, I will present about the management typically has three broad objectives in designing an effective internal control system. So there are three broad of objectives, which the first is reliability of financial reporting. The management is responsible for preparing statements for investors, creditors, and the other users. The second will be talking about efficiency and effectiveness of operations. The control within a company encourage efficient and effective use of its resources to optimize the company's goals. And the last one is compliance with laws and regulation. The Section 404 requires management of all public companies to issue a report about the operating effectiveness of internal control over financial reporting.
Well, for the next is the contrast management responsibility for maintaining and reporting on internal control with auditor responsibility for understanding, testing, and reporting on internal control. Management, not the auditor, must establish and maintaining the entity's internal control. This concept is consistent with the requirement that management, not the auditor, is responsibility for the preparation of financial statement in accordance with applicable accounting frameworks such as GAAP or IFRS. Two key concepts underlie management design and implementation of internal control, reasonable assurance, and inherent limitation. So for reasonable assurance is a company should develop internal control that provide reasonable but not absolute assurance that the financial statement fairly stated. So the concept of reasonable assurance allows for only a remote likelihood that material misstatement will not be prevented or detected on a timely basis by internal control. Next is inherent limitation. Internal control can never be completely effective regardless of the care followed in their design and implementation, even if management can design an ideal system. Its effectiveness depends on the competency and dependability of the people using it. Assume, for example, that a carefully developed procedure for counting inventory requires two employees to count independently. So, management assessment of internal control over financial reporting consists of two key aspects. The first, management must evaluate the design of internal control over financial report, and the second is management must test the operating effectiveness of those controls. The first one is design of internal control. Management must evaluate whether the controls are designed and put in place to prevent or detect material misstatement in the financial statement. The second one is operating effectiveness of control. In addition, management must test the operating effectiveness of controls. The testing objective is to determine whether the control are operating and designed and whether the the person performing the control possess the necessary authority and qualification to perform the control effectively. The auditor obtain the understanding of internal control to assess control risk in every audit. Auditors are primarily concerned about control over the reliability of financial reporting and control over classes transaction. There are two. The first one is controls over the reliability of financial reporting. Uh, to comply with the second standard of field work, the auditor focuses primarily on controls that related to the first of management internal control that concerns reliability of financial reporting. Financial statements are not likely correctly reflect GAAP or IFRS if internal controls over financial reporting are inadequate. The second one is control over classes of transaction. Auditors emphasize internal control over classes of transaction rather than account balance because the accuracy of accounting system output accounts balance that depends heavily on the accuracy of inputs and processing transaction.
The next we'll be talking about five components of internal control. The control environment consists of the actions such as policies and procedures that reflect the overall attitude of top management directors and owners of an entity about internal control and the important entity. To understand and assess the control environment, the auditor should consider the most important control subcomponents, which are the first is integrity and ethical value integrity. The second is commitment to competence. The third is board of director or audit committee participation. The fourth is management philosophy and operating style management. The fifth is organizational structure, and the last one is human resource policy and practices. The risk assessment for financial reporting is management's identification and analysis of risks relevant to the preparation of financial statement in conformity with appropriate account standards. The third is control activities. The control activities are the policies and procedure. In addition to this, include in the internal control components that help ensure that necessary action are taken to address risk that achievement of the entity's objective. The adequate separation of duties. There are four general guidelines for adequate separation of the control activities to prevent both fraud and errors are especially significant for auditors. The first one is separation of the custody of assets from accounting. It is needed to protect a company from embezzlement. A person who has temporary or permanent custody of an asset should not account for that asset. The second is separation of the authorization of transaction from the custody of related asset. It is desirable to prevent persons who are authorized transaction from having control over the related asset. The third one is separation of operational responsibility from record-keeping responsibility. It is needed to ensure unbiased information. Record-keeping is typically the responsibility of a separate department reporting to the controller. The separation of IT duties, user department as the level of complexity of IT system increases, the separation of authorization, record keeping, and custody often becomes blurred. The proper authorization of transaction and activities. There are two types. The first one is general authorization. The general authorization is management established the policies and subordinates are the instrument of this general authorization by approving all transactions within the limits of the policy. The second is specific authorization applies to individual transactions. For certain transaction, it prefers to authorize its transaction. As example, is the authorization of sales transaction the manager for used car company. There are three, which is adequate documents and record, to physical control over assets and records, and the last one is independent checks on performance. The fifth one is information and communication system. It is needed to initiate, record, and process and report the entity's transaction and to maintain account as the ability for related assets. The fifth one is monitoring. The monitoring is an activities deal with ongoing or periodic assessment of the quality of internal control by management to determine that controls are operating as intended and that they are modified as appropriate for changes in condition. The last topic I will be present about is obtain a document and understanding internal control. The first step of the obtaining document and understanding internal control is to assess control risk. And we are moving forward to design, perform, and evaluate these controls. The last step is to decide on plan detection risk and to substantive tasks. The reason for sufficiently understanding internal control, which are mentioned in SAS 55 as amended by SAS 78 and 594 plus AU 3109 requires the auditors to obtain an understanding of internal control for every audit. The minimum audit planning matters has 4 points, which are the auditability, potential material misstatement, detection risk, and design of the task. Back to Cindy.
Okay, next slide, please. Okay, next we have the evaluate internal control implementation. First, we have to update and evaluate auditors' previous experience with the entity, and then make inquiries of clients' personnel, and then examine documents and records. Next, we need to observe entity activities and operations, and then last, perform walkthroughs of the accounting system. Next slide. Next slide, please. Okay. Next up, we have the access control risk by linking key control, significant deficiencies, and material weaknesses to transaction-related audit objective. First, we need to assess whether the financial statement are auditable, and then we determine assess control risk supported by the understanding obtained, assuming the controls are being followed. And then we use control risk matrix to assess control risk. And then we identify deficiencies, significant deficiencies and material weaknesses. And last, we need to communicate to those charged with governance and management letters. The control of risk matrix is identify audit objective, identify existing controls, associate controls with related audits objective, identify and evaluate control deficiencies, significant deficiencies, and material weaknesses, which can be done by identifying existing controls, identify the absence of key controls, determine the misstatement that could result, and consider compensating controls. Next is the process of designing and performing tests of controls. Test of controls is the procedure to test effectiveness of controls in support of a reduced assessed control risk are called the test of controls. Procedures of test controls, there are four procedures. First is make inquiries of client. Second, examine documents, records, and reports. Third, we have observed control related activities, and fourth is we perform client procedures. Next up, we have decided plan detection risk and design substantive tests. The auditor used the result of the control risk assessment process and test of controls to determine the planned detection rates and related substantive tests. The auditor links the control risk assessment to the balance related audit objective. Next is section 404, requirement for auditor reporting on internal control. The scope of auditor's report on internal control is limited to obtaining reasonable assurance that material weaknesses in internal control are identified. Thus, the audit is not designed to detect deficiencies in internal control that individually or in aggregate are less severe than the material weaknesses. The distinctions between efficiency significance deficiencies and material weaknesses was discussed earlier. Okay, so the requirement we have three. First is unqualified opinion. The auditor will issue an unqualified opinion on internal control over financial reporting when two conditions exist. First, there are no identified materials weaknesses, and there have been no restrictions on the scope of auditor's work. Next is adverse opinion. It is when one or more material weaknesses exist, the auditor must express an adverse opinion on the effectiveness of the internal control. The most common cause of adverse opinion in the auditor's report on internal control is when management identify material weakness in its report. And last but not least, we have qualified or disclaimer of opinion. A scope of limitation requires the auditor to express a qualified opinion or a disclaimer of opinion on internal control over financial reporting. This type of opinion is issued when the auditor is unable to determine if there are material weaknesses due to a restriction of the scope of the audit of internal control over financial reporting or other circumstances where the auditor is unable to obtain sufficient appropriate evidence, because the audit of the financial statement and the audit of internal control over financial reporting are integrated. The auditor must consider the result of audit procedures performed to issue the audit report on the financial statement when issuing the audit report on internal control. Next. Next slide, please. Okay, last we have the deficiencies in evaluating, reporting, and testing internal control for non-public companies. There are 5 of them. First is reporting requirement. In audits of non-public company, there is no requirement for an audit of internal control over financial reporting. The auditor therefore focus on internal control only to extent needed to do a quality audit of financial statements. Second is extent of required internal controls. Management, not the auditor, is responsible to establish adequate internal control in non-public company. Just like management for public companies, if the control environment or the documentation is inadequate, the auditor may decide to withdraw from the engagement or issue a disclaimer of opinion on the financial statement. Also, when run non-public companies understand the importance of the effective controls to reduce the likelihood of errors and fraud and to improve effectiveness and efficiency. Third, we have extent of understanding needed. Auditing standards require the auditor obtain a sufficient understanding of internal control to assess control risks. In practice, the procedures to gain an understanding of internal control vary considerably from client to client. For smaller non-public clients, many auditors obtain a level of understanding sufficient only to assess whether the statements are auditable and to evaluate the control environment for management attitude towards internal control. Then fourth, we have assessing control risk. The most important difference in non-public company and assessing control risk is the assessment of control risk maximum for any all control related objective when the internal controls for the objective are non-existent or ineffective. Because of the expectation that public companies should have effective internal controls for all significant transactions and accounts, there is an initial presumption that control risk is low in the audit of public company financial statement. Thus, it is unlikely that public company auditor will make a preliminary assessment of control risk at maximum. As with public company audits, it is useful for auditors to use control risk metrics for non-public companies audits. And last, we have extent of tests of controls needed. The auditors will not perform tests of controls when the auditors assesses a control risk at maximum because it's inadequate controls. When controls risk is assessed below the maximum for a non-public company, the auditor designs and perform a combination of tests of controls and substantive procedures to obtain reasonable assurance that the financial statements are fairly stated. And that is the end of our presentation. Please let us know if you guys have any questions regarding the materials. With that being said, that is the end of our presentation. I'm sorry if we made some mistakes here and there, and sorry for any inconvenience. Thank you for watching our video, and I hope you guys find it helpful. Thank you, and Assalamualaikum warahmatullahi wabarakatuh.